Welcome, everyone, and thanks for joining us for iCM's second quarter 2026 quarterly market insights presentation. I'm Mike Paciotti, iCM's Chief Investment Officer. I'll be joined shortly by our Director of Investments, Ryan Lehman, and we'll be your host for today's presentation. So that was then and this is now. The title of my colleague Ryan Lehman's most recent quarterly market insights letter, and very appropriately stated to reflect not only the contrast that has occurred in capital markets since year end, but also the change that has occurred just since March 1st. So taking you back 6 weeks, markets had enjoyed a gangbuster beginning to 2026, with the S&P 500 closing at 69.46 on February 25th, sitting just below its all-time high close of 69.77, which was recorded on January 12th. International and emerging markets jumped out to a roaring start to begin 2026, with the emerging markets index gaining 15% to start the year. And while rumblings of issues within private credit space continued to percolate, they were kind of just that, just rumblings at that point. As Ryan appropriately said, that was then and this is now. In March, as the conflict in Iran escalated, U.S. stocks declined by 5%, while emerging market stocks declined by 13%. But a new leader emerged, commodities. So as we close the end of the first quarter, the Bloomberg Commodities Index holds the lead at about a 24% gain year to date among broad asset classes, with non-U.S. developed and emerging markets and U.S. bonds, for that matter, essentially flat, while U.S. stocks are down 4 to 5%. Not terrible considering, but lying in stark contrast to where we were just 6 weeks ago. Now, historically, outside of the onset of war, markets and economies have historically done rather well during times of conflict, likely due to the extra spending that wartime creates and the corresponding economic boost. This time, we have a new variable, that being cost push inflation and what that means to the consumer, equity markets, and fixed income markets. So we'll get into that in a little bit more detail. Now, outside of the Iran conflict, we have a cross current of influences ranging from the quiet storm that is developing within private credit, rising default rates, and the corresponding gating that has occurred by private credit funds, which we'll cover, along with what had generally been a pretty strong economy buoyed by a resilient consumer and a robust CapEx spending environment due to the whole AI craze that's been occurring. And finally, I'll turn it over to Ryan to review year-to-date performance in equity and real assets and what that valuation landscape looks like and why really Asia has kind of been disproportionately impacted by the early goings of the Iran war. So let's jump into it. And with that, let's kick things off by taking a look at the economy. So jumping right in with the general economic backdrop, after two exceptionally strong prints in the second and third quarter, fourth quarter real GDP sank to its worst level aside from the Liberation Day quarter since really the second quarter of 2022. So after revisions, the reading was a meager 50 basis points for an annualized quarter-over-quarter rate. Now, large grain of salt here, folks, as we get into the details. The consumer did fall off from the torrid pace of the second and third quarter, but produced a very respectable 1.3% contribution to real GDP. CapEx was rather subdued, but in line with what a normal quarterly contribution should be at about 26 basis points. Inventory buildup accounted for another 14 basis points. Even net exports only subtracted a very modest 22 basis points. The primary issue was government spending, which subtracted 1 full percentage point for the quarter-over-quarter GDP result, mainly the result of the government shutdown, which occurred due to the political jockeying, for lack of a better term, that occurred during the fourth quarter. Now, on the inflation side, core PCE, which is addressed on this slide, continue to really trend in the wrong direction at 3% as of the December reading and a tick hotter in January at 3.05%. Now, February's cooled slightly back to 2.97%. Services sector inflation was the main culprit, with a good chunk of it coming from financial services as asset management fees continue to climb, with strong capital markets, which were roughly 20-ish% higher than 1 year earlier, contributing roughly 57 basis points to those numbers in January, 48, another 48 in February, with rising healthcare costs contributing about 55 basis points in that February print as well. Now, another trend that I do want to point out, we had experienced 23 consecutive months of deflation in durable goods, which ended last May. Now, since then, we've had 9 consecutive readings of rising prices in this space, with February at plus 34 basis points, with recreational goods and vehicles and home furnishings being the drivers there. Again, not a big contribution because the weight in the index is low. But for example, furniture rose at an annual 4.8% annualized rate. So definitely a little hot there within a segment of durable goods. Now, let me pivot a little bit and address the Iran conflict as it relates to inflation. So this slide shows the Strait of Hormuz traffic pre and post conflict. What we can clearly see is that there's practically no shipping occurring through the strait, with the primary implication being a reduction in the global oil supply and escalating prices. Now, a few things to clarify. This is a global problem. Just because the U.S. is quote unquote energy independent doesn't mean that we are not impacted. Oil companies are private businesses that sell onto an open global market at the then current price. We are impacted directly and indirectly as other goods increase in price as well. So we should all be very well aware of the fuel component of this as we fill our tanks. But the spillover into other goods and services has yet to really come. Now, as of the most recent inflation reading from the early part of April, this indicated very little spillover effects of inflation onto other goods and services from the very early days of this conflict. But this is something very, very much so that is worth watching as this conflict tends to drag out. Now, Asia has a little bigger problem in that 80 to 90% of the oil flowing through the strait goes to Asia. So now Ryan's going to get into this in a little bit greater detail later in the presentation. But as it relates to inflation, practically every good that's sold, whether it's shipped or sold in a storefront, will have some impact from rising energy prices that must be accounted for in the price of that good. So to the extent that this is short-lived, the effects should be very minimal. If this is longer lasting, one must wonder if the Fed will be faced with a very quote-unquote Volcker-like moment where they need to sacrifice the economy for the sake of inflation, right? So this is related to Fed rate cut expectations, which is actually my next slide. So as I mentioned on the last slide, here we could see the seismic shift that has occurred in Fed rate cut expectations. As of February 27th, the market was expecting nearly 2.5 rate cuts in 2026. That narrative has completely changed, with some wondering if hikes will be required in that Volcker-like trade-off I mentioned just a few seconds ago. So what do we think about this? Markets tend to extrapolate what's happening currently and take that to an extreme. So I doubt that the conflict will cause long-lasting price changes that will really need to be dealt with. But that said, I also don't really feel like cuts are appropriate amidst the economic and capital market strength that we've seen. So neutral feels about right to us in this environment. Now, some would argue that jobs had been deteriorating, which we've actually seen a modest amount of weakening there, but one must really question what amount of that is due to the AI disruption, or at a minimum, just a general cooling from the very robust jobs market that we've been in really since the end of the COVID era. So, needless to say, overall jobs remain relatively strong and, in our opinion, hardly need to be dealt with by cutting interest rates, if that would be effective at all. So, absent a crisis, think maybe private credit affecting the insurance companies or the banks, we really see very little need for cuts in this environment. So, shifting gears to fixed income, the start of 2026, Q1, was mediocre at best, with most fixed income asset classes falling somewhere near flat for the quarter. So, short term treasury bills are proxy for cash, and high yield munis were the leaders, gaining 85 and 71 basis points respectively, with emerging markets local currency debt as the laggard, losing 2.25%, as indicated by the orange bars on this slide. Now, the blue bars show the return of the last month, with the major takeaway being that most fixed income asset classes were performing quite well until the onset of the Iran conflict and the corresponding inflation fears. So, for example, while high yield munis were a leader, that was simply the result of the very robust performance in January and February, as the asset lost nearly 2% in March. Right, the same could be said for virtually every fixed income segment, save emerging markets debt, which was not only hurt by rising inflation fears, but also by the strengthening of the U.S. dollar in a typical crisis flight to safety type trade. Um, so, since broad fixed income valuations are actually pretty good, we tend to view this quarter as somewhat temporary, depending on really what the inflation spillover effect is from a prolonged shutdown of the strait and how long this conflict tends to drag on. Now, one of the implications of reduced Fed rate cut expectations and a direct consequence of higher near term inflation expectations has been a reversal of what's been a near 3 year trend of yield curve steepening. So, the move I'm referring to can be seen in either the left panel, reflecting the steepness of the 10-2 segment of the curve, or the overall curve as reflected by the 30-2 segment. Now, since 2023, as the Fed has removed restriction by cutting rates, yields have fallen more for short term bonds than for long term bonds, removing the inversion and restoring a positive slope of almost 100 basis points for the 10-2 segment and nearly 140 basis points of overall curve steepness. However, amidst this larger steepening trend, the curve reverted to flattening during the crisis as short-term inflation expectations drove short yields higher more than for long yields. This can be seen in either table, with the curve sitting 18 basis points flatter since year end for the 10-2 segment and 30 basis points flatter overall. So, in our opinion, the curve remains a tad flatter than what we would expect as normal, but nothing extreme by any stretch of the imagination. Now, in the last slide, I spoke to the flattening of the curve during the past month as a result of rising inflation expectations, specifically rising short term inflation expectation. This slide speaks to that very point. As we can see, the blue line reflects market expectations for inflation over the next 2 years, with a noticeable increase in inflation occurring in March. Since year end, 2 year inflation expectations have increased by nearly 100 basis points. Conversely, 10-year inflation expectations have increased by just 13 basis points, basically telling us that the market expects inflation from the war to be short lived, but also explaining the near term flattening of the curve that we saw in the prior slide. Finally, let me devote these last few slides to issues emerging in private credit space. So private credit simply refers to loans that are made outside of the traditional banking system and public markets. So traditional lenders include asset managers, private funds, and institutional investors. The lenders typically provide financing for highly levered or speculative borrowers that may not be established enough to access public markets. So these loans are then packaged together and sold to investors via private investment vehicles, or in some cases can be accessed through publicly traded business development companies. So the goal, package a bunch of potentially high risk investments together and entice investors with attractive yields, much like what occurred with mortgages during the financial crisis. But this time, you could simply replace mortgages with private loans. Now, data is limited due to the private nature of these transactions, but public BDCs offer us a bit of a glimpse into a really murky asset. So year to date, business development companies or BDCs have declined by approximately 10%, as seen by the chart on the left. Now, more importantly, these BDCs are trading at a 17% discount to the stated book value, which starts to sound a bit like closed-end funds. So there's a very important contrast here, folks. With closed-end funds, they transact in liquid, publicly traded instruments, traditional stocks and bonds. So the value of the underlying, the NAV, is known. Therefore, deep discounts typically equal opportunity in closed-end funds. Here, while this may look similar, the discount is more of a reflection of the fact that the underlying assets haven't been valued and the NAV has yet to be written down, the exact opposite of what we see in closed-end fund space. So to be clear, while these may appear like closed-end funds, the signals are very different. Where we would see opportunity because of the transparency of the underlying within closed-end funds, BDCs are murky and anything but transparent and are likely reflecting asset write-downs to come in the underlying loans, not opportunity at this point. For this very important reason, we do not view BDCs as an opportunity and are not invested in this space at this time. The second issue I mentioned in my opening remarks with regard to private credit is gating. So gating refers to private credit funds denying redemption requests. So plainly stated, investors want their money back and are being refused. In the beginning, this was kind of limited to one or two funds, but has since become pretty prevalent. So this slide shows the redemption cap, or the amount per quarter a fund is willing to redeem versus what is being requested. So typically funds limit redemptions at the value of expected maturities from loans within the portfolios or cash flows, with some using lines of credit to extend a bit beyond that. So this is where really that kind of the contagion potential exists, with the banks extending these lines of credit. Now, as we can see, requests have far and away outpaced redemption caps. In a way, though, while this is bad for investors in private credit, it likely prevents fire sailing of the underlying portfolios, and it's kind of keeping this somewhat contained to private credit space. That is limiting the contagion to adjacent assets like bank loans or public high yield bonds for that matter. So this next slide shows spreads of public high yield bonds. So we showed this chart last quarter to illustrate those concerns really hadn't spread to public markets yet. So we started to see some modest spread widening occur this quarter in public high yield markets, but it's probably more likely to do with the Iran conflict than it has really much to do with private credit space. So thus far, the issues in private credit have not infected adjacent assets like public high yield bonds. That said, valuations in high yield space are still very stretched, and we continue to view this asset as an asset class really investors should want to avoid. Now, despite the fact that we find valuations rich in high yield bonds, the overall credit quality of the index has actually trended upward. So this is likely the result of the poor credit quality borrowers preferring to borrow in the murky waters and covenant light space of private credit. So the side effect has been a reduction in the C-rated bonds and a noticeable increase in the double Bs, the upper credit quality segment of high yield. So this likely plays a role in somewhat of a role in the very narrow credit spreads we see in high yield bonds, but not really enough to explain away and account for how rich valuations are in this space. So again, to be clear, while we do see potential for declines in public high yield bonds, it would likely be more the result of a general repricing of risk, not from a truly bad default environment that has occurred in this asset historically. So that's going to do it for my section on the economy and fixed income markets. I'm now going to turn over to Ryan to discuss equities and real assets. Ryan?
Yeah, great. Thanks, Mike. So as would be expected with the conflict in Iran, rising interest rates, and soaring commodities prices, it was a bit of a difficult quarter for equity markets, with the bulk of those losses actually coming in March. So U.S. large caps at a broad level, they declined by just over 4%, but we saw a great deal of dispersion across market cap and style. So although large growth stocks were the laggard, declining by nearly 10% for the quarter, large value stocks and small caps actually finished in positive territory. And in addition to that, we also saw some pretty strong returns out of REITs. And we'll dive into really what's behind the large cap growth performance in a couple of slides here. On the international front, developed and emerging market stocks, they lagged in March, with which Mike alluded to in his opening comments. But EM and EFA value still finished the quarter in the black. And this was largely due to strong returns that we saw in January and February, as many of those fundamental tailwinds that we've discussed or we've been discussing for much of the last year or so continue to be priced into the asset class. And then the big winner on the quarter, that was commodities. So here we're looking at the BCOM index. That was higher by 24% in Q1. However, if we were to look at the GSCI index, which is going to carry a larger weight to energy-related commodities, that actually soared by more than 40% just in the first quarter alone. Now, the greatest contributor to all this, it's obviously been the Iran conflict, but more importantly, the Strait of Hormuz. So the Strait is the Middle Eastern waterway that's responsible for transporting around 20% of the global oil supply. And it's also a critical shipping route for liquefied natural gas as well as nitrogen, which is going to be a key component in fertilizer production. And what we've seen is that total commercial vessel crossing since the conflict began has essentially been zero. And that's generally the case right now, even despite the ceasefire agreement that occurred back on April 7th. And as you'd expect, cutting the global oil supply by 20% is bound to have a meaningful impact on prices, which is exactly what we saw in March. Now, diving a little bit deeper into performance, though, in the quarter, it's really been a tale of two very different markets, pre and post conflict. So, prior to the start of the U.S. strikes, non U.S. stocks and even U.S. value and small caps had gotten off to a very, very strong start to the year. U.S. growth stocks were really the only major asset class to be squarely in negative territory. Then, as the conflict evolved, markets kind of sold off in unison, with non-U.S. stocks really feeling the brunt of the pain, as they tend to be much more dependent on Middle Eastern oil. And we'll get into that in a couple slides here. However, at the end of the day, despite the declines in March, many of the assets that we favor in our strategies actually finished the quarter in positive territory, despite those steep declines that we saw on the growth side of the market. Now, speaking more specifically to the growth asset class, the poor performance we've seen from the segment, it's really been driven by two things. So one is Iran related, and the other's not. So the first relates to massive capex spending plans from most of the so-called AI hyperscalers. These were announced early in Q1, and they put significant pressure on a handful of Magnificent Seven names. The reason being is that investors were very skeptical of whether or not or how quickly the tens of billions of dollars that these companies were planning to spend were actually going to translate into any type of significant return on investment. Now, the other headwind has kind of been a second derivative of the Iran conflict. So, as inflation expectations and interest rates have risen, what this does is it also increases the inherent discount rate for stock prices. So, the discount rate is simply the rate that's going to determine a present value of a stock based on its future earnings and dividends. And as that discount rate increases, future earnings become worth less today, which should translate into shrinking PE ratios and valuations. Now, because growth companies typically pay little dividends and investors are paying high prices today for that future earnings potential, these shares tend to be disproportionately impacted compared to value stocks. And that's exactly what we've seen in price action over the last quarter. Now, the last thing that I wanted to note, which is what's displayed on this slide, is that growth stocks as a whole didn't necessarily perform that poorly in Q1. It's really just been more a handful of stocks. So if we look at the top detractors, and you're most likely going to recognize all the names here, the top 8 names contributed roughly 6.5 of the index's 9.78% negative return. So it was really the Mag 7 and then some of those AI related names that were really the key decliners and the key detractors for the growth asset class during the quarter. Now, on the non-U.S. front, we already talked a little bit about EM and non-U.S. markets in general, really having been hit the hardest from the Iran conflict, but we didn't really dive into the reason why. Well, I think this slide really gives a good indication of why that's been. So if we look at Asian markets in particular, which are going to account for a large portion of the MSCI EM and MSCI EFA indices, you're going to see very steep declines in March. In particular, Korea has declined by 25%, despite still being higher by around 16% on a year-to-date basis. And this is largely due to their dependence on Middle Eastern oil imports. Now, unlike the U.S., who is actually a net exporter of oil, these countries import the majority of their energy needs, with Japan and Korea being the most reliant on the Middle East. Now, what this does is it creates an issue because not only are these countries feeling the pinch from higher oil prices like we are at home, but unlike the US, they're also facing the risk of actual shortages the longer the strait remains closed. So that said, we would expect to see a reversal in this price action once the strait does reopen, or there's some prospects that the strait is going to reopen, because the fundamental and valuation story that is still alive and well. And as we actually saw some of this in action, some of that reversal following that temporary ceasefire that was announced back on April 7th. Now, the other contributing factor to the non-U.S. pressure in March has been a strengthening of the dollar. As interest rates have increased in the U.S. and the price for oil has soared, this has created excess demand for the USD, which has led to a pretty sizable short-term rebound in strength. That said, the dollar did act as a very meaningful tailwind for non-U.S. assets as it weakened for the majority of 2025. And in just the last week, we have seen a little bit of a reversal since that ceasefire was announced. And it's not illustrated on this slide, but from a valuation standpoint, the dollar does still look expensive versus its long-term fair value compared to both developed and emerging markets currencies as we look ahead. And as such, we do remain in our stance that the likely path of the dollar from here is still weaker as we look out over the next cycle. Now, I did want to take one step back from the negative storylines for the next couple of slides because we talked at length about the impact that the Iran conflict has had on markets in the first quarter. However, a lot of the intermediate term and long-term tailwinds that we have been talking about are still intact. So starting with the panel on the left, we've got no indication that the war is going to have any impact on the massive capex spending plans by AI hyperscalers. As we talked about in last quarter's presentation, this is likely going to help support U.S. GDP growth, at least in in 2026. And then on the earnings front, the conflict has really done little to make investors less optimistic. So earnings growth still expected to be robust in 2026. And this is particularly true within small caps and EM, where earnings are coming off much more depressed levels than kind of what we've seen within U.S. large caps. And then lastly, just to wrap up with valuations, we don't see any major changes here, but I did want to just reinforce the story that the greatest opportunity still remains within non-U.S. stocks and within the U.S. Within value stocks. So if we just go across the board here, U.S. stocks and growth in particular, they do continue to look expensive despite the pullback we saw in Q1. Within U.S. large value, stocks here are slightly expensive. However, if you were to look at deeper value, high quality stocks, you'd see that they look particularly attractive today. And then small value, that's actually moved a bit inside of fair value, something that we've been keeping an eye on for the last year or so. And then lastly, on the right side of this chart, you're going to see international value and emerging value stocks still well below fair value despite the strong returns that we saw last year. So moving on to real assets and alternatives, getting to commodities, they were really felt the largest impact of the Strait of Hormuz closure. And in particular, if we look at oil prices, WTI peaked out at above $110 near quarter end and currently sits around $100. This has clearly played a meaningful role in those strong returns that we've seen from the commodities index on a year-to-date basis. However, if we look at where markets are actually pricing oil going forward, the general expectation is actually that these prices are going to come back down as we get some resolution to the conflict. You're going to see that in the chart to the right. So here we're plotting the current shape of the futures curve, which is currently downward sloping or in a state of what's known as backwardation. So what this essentially implies is that the short-term supply imbalance is pushing prices up at the front end of the curve. However, as that normalizes, the market does expect the price per barrel to settle in, say, that $70 to $80 a barrel range by the end of the year. Now, not surprisingly, this has had a meaningful impact on our return assumptions for commodities over the next 10 years. Coming into the year, we expected an annualized return in the ballpark of, say, 8%. Given the fact that commodities have returned upwards of 40% in just the last 3 months, this has effectively cut our outlook in half, given that you've pulled so much of that future return potentially forward. So for those who have been the beneficiary of those outsized returns we saw in Q1, it might be an opportune time to take some of those profits off the table. It is something that we're currently thinking about for our strategies that are utilizing commodities and do have an exposure to the asset class. And then finishing up here with closed-end funds, with the uptick in volatility and widening spreads, we would expect discounts to widen out a bit in March, which is precisely what happened. On a positive note, however, this has increased the overall attractiveness of the universe. We now have the average fund trading at a discount of just over 5%, which is a full tick wider than the long-term average. Now, we probably do need to see discounts come out a bit more before you start to see those screaming buys. But as a whole, closed-end funds do appear much more attractive than they were last year, and there are a good number of selective opportunities out there. So just to kind of tie everything all together, let's just walk through our asset class return forecast and some strategy positioning. So starting with our long-term return expectations, we have seen some meaningful changes this quarter. So international emerging markets, they continue to look relatively attractive by a wide margin. So not really any change there. However, commodities have seen a large shift to the left with our 10-year annualized return forecast essentially being cut in half from around 8% at year end to now just over 4%. And then on the left-hand side, you'll notice that we've also seen a slight uptick in our expectations for U.S. large growth and U.S. large caps in general, although keep in mind that both of those figures are still well below the long-term historic norms. And all this is going to translate into our strategy positioning. So we've got a pretty sizable underweight to U.S. stocks. And within the U.S., our most meaningful tactical position, that's going to be an overweight to U.S. value, with that value positioning being largely focused on attractively valued deeper value, high quality names. And then outside of the US, we've got meaningful overweights to both international and emerging markets value. We didn't make any changes this quarter, but late last year we did slightly increase our allocation to small caps and REITs, which has been additive to performance. And then we do still own commodities. However, we may be reducing that weight due to that outsized performance that we saw in Q1. And then on the fixed income side of the equation, no change to our allocation here. We do still favor EM bonds and have a generally neutral duration position. However, we do still have that underweight to corporate credit. Like Mike alluded to in his comments, we did see spreads move out a bit in Q1, but the valuation environment, it does remain rich for both investment grade and high yield bonds. So that's going to do it for this quarter's Market Insights presentation. If you enjoyed the presentation, please feel free to like, share, and subscribe. Also, if you have any questions or would like to learn more about our product offerings, please feel free to reach out to a member of our advisor services team. You can see all their contact info on this slide, as well as our website address. Thanks for watching, and I hope you'll join us again next quarter.